Hello, friends. My name is Deepak, and with me is Sanjeev Gupta, CPA. And today we want to talk to you about K1s. So this is that time of the year where we are getting all kind of documents, our K1s, all kind of, and all of you guys are probably busy collecting all that. But K1s are very important. They can have a big implication on your tax return because how they play into your overall tax scenario. So that's what I want to talk to Sanjeev ji today about and kind of bring a little bit more clarity around K1s. So Sanjeev ji, obviously we get K1s from partnerships, we get K1s from S corps, we get K1s from syndicates out there. So if you don't mind, maybe tell us a little bit about different type of K1s. Maybe people are not familiar with that. That people probably think K1 is a K1. What's the difference? But obviously they are different. So maybe talk a little bit about that and help us understand. Why do I care one type of K1 versus another type of K1?
Yes. So first of all, let's understand the definition of a K1. K1 is a share of a person who is a partner or a shareholder in a one entity. In terms of the share is in terms of his percentage ownership. In what sense? It can be from profit from the business. It can be interest income. It can be like the business invested money in a CD or some kind of other investment vehicles where they're generating interest income. It can be the money has been invested, the business entity money has been invested in a other like stock transaction, other areas, and they're getting capital gains from sale of those investments. So interest income, capital gains, it can be royalties, it can be other treatment, other types of income. So this tracking of all kinds of income comes on a separate stated form, which is a K1. K1 reflects all types of income, all types of deductions, and also contains information relating to what can be they can use on their personal returns, like qualified business income deduction, basis, distributions, AMT tax credits. So all those things are it flows to the personal from the company. The reason why it flows to from the company to personal because lot of things are being tested at individual level, not at the company level. Because you might be investor, you might be a shareholder, it might be a partner in different entities. All collectively from those income, from those areas that flows to your personal. Personal will determine how much you can take income whether active income, passive income, active loss, passive loss, QBI deduction, depreciation calculations, 179 calculations, all are determined that they all collectively come forward and finalize at your personal level. And also remember this K1 is kind of creating a link between the entity and personal returns. And that's why is known as pass to entities. Pass to entities is done through these K1s that link your company entities and your personal. That's why you don't pay taxes at the corporate level because all types of income and deductions are flowing to your personal return and then they are taxed at that level. Now that's the K1. Now K1 comes from different entities, like I said, different types of entity. It can be a partnership, it can be S corporation. Partnership means partnership can be general partnership, two or more people coming together. It can be limited partnership with one general partner, others are general partners, others are limited partners. It can be LLC, can be treated as LLC is a very flexible structure. It can be treated as partnership. It can be treated as a S corporation. It can be treated as a C corporation. It can be treated as the way you want, very flexible structure, but it provides a limited liability protection. Or it can be a S corporation. Now, S corporation does not mean it's a different entity. It's still a C corporation, which is a regular entity. But for tax purposes, you make a separate election under by filing a form 2553 and is created under subchapter S of the IRS code, and that's why it's known as S corporation. So this type of the K1s from each entity type of entity are different when it compares from partnership to S or S corporation. Reason for that is one is corporation, one is partnership, or LLC, tax as a partnership or tax as a S corporation. So one if you are a shareholder in one company, that that determines the shareholder ownership that is based on the articles of course it depends on the bylaws, the company bylaws, the company operating agreement, whereas partnership LLCs are determined by the operating agreement among partners. It's not it's not it's not like it follows a particular statute. In case of corporations, they follow a proper statute. They have to have meeting minutes, they have to have directors, they have to have proper protocol. for doing any kind of deductions. Not in case of partnership LLCs. They follow a flexible structure not determined by any statute. So there are differences from tax point of view. For if you see on the LLC from the partnership level, the K1 that you see from a partnership or LLCs, first of all, it determines what type of partner you are. You are a general partner. What do you mean by general partner? General partner is any person who is taking decision and involved in uh, operation of the business and take unlimited liability for running that business because he's the manager of the business. It can be limited partner. It can be a foreign partner. It can be a disregarded entity. So different types of people can be in the partnership. But in case of S corporation, you only can have individual or limited scope for trust. Trust can become a partner, disregard or Q-sub can be a part of it. But other than that, you cannot exceed more than 75 number for shareholders in the S corporation. Nothing is there, no limitation. You can, if you are a foreign partner, he can become a partner in this partnership in the LLC. Nothing, but that person cannot be a shareholder in S corporation. So that's also a big difference between two entities. You see on the K1, you reflect on the K1 from partnership, you reflect what type of partner is that. But on the shareholder side, on the K1, there's only can only have individuals or a disregarded entity or Q subs. So that's why there's no type on that K1s from the S corporation. On the K1 from the partnership, you have to have a capital account, opening balances, ending balances. So it starts with the proper calculations, how much capital contributed, how much profit taken out, distribution, everything is shown on the K1. Nothing is shown on the K1 from the shareholder side. Of course, it shows the beginning balance, ending balance. That has been ended. The loan taken also is added on the K1. But other than that, nothing is shown on the K1 from the S corporation. Now, K1 from the partnership LLCs is subject to self-employment taxes if it's a general partner. If the box is marked as a general partner, the ordinary income subject to self-employment taxes is highlighted on one of the boxes. It shows self-employment income and subject to self-employment taxes. Self-employment taxes is nothing but Social Security Medicare. In case of S corporation, the box number one, which is ordinary income, is not subject to self-employment taxes. Reason for that, that's the big difference because that income is taxed as ordinary income and flows to your personal 1040, but it's not subject to SC tax, a separate calculation like we have for LLCs. But if you are a limited partner in LLC, the K1 for that limited partner will not be subject to self-employment taxes if and only if it's not that limited partner not subject to self-employment taxes. That's also a wrong notion. Only and only if they are not in any way taking any kind of payments, indeed payments, or any kind of scenarios where they're involved in any kind of activity. Distribution can be recharacterized as a payment and is subject to self-employment taxes. If you just invest your money, the general partner takes care of it. You not involve any time into it, and definitely your income will not be subject to self-employment taxes in case of partnership. In case of S corporation, like I said, the K1 does not show any self-employment income. That's also important there. Now, in case of LLC, the basis means what is the basis means capital contribution, initial capital contribution plus profit earned minus distribution. But in the case of the capital account of the partners in a case of LLCs partnership, they include the loan taken from anywhere. Because why is it include the loan? Because each partner are severely and jointly responsible for the debt of the partnership liabilities. In case of S corporation, the scenario is different. Only the loan given by the shareholder to the company is taken as a basis. If the company takes a loan from outside agency, third party like a banks or other institutions, that loan will not be forming the basis. So it's important. The difference is important because if there is a loss in the entity, if it's a partnership, then loss in the entity can be taken on your personal return. Again, remember it flows on the K1. K1 flows to the personal, which is tested at the personal level, and then we see at the personal level what is the basis. The 7203 form that is going with the K1. 7203 form, by the way, is a basis. It shows the basis for LLC partner and S corp partner. So 7203 in the case of partnership will include the liabilities, but in case of 7203 for the shareholder, if his loan is taken from outside agencies, that will not be included. So if there's a loss will not be allowed if it exceeds the basis in case of S corporation. So loss will remain suspended in case of S corporation. S corporation shareholder. It can be activated provided the S corp shareholder put the money in, or there's excess profit, or there's more profit in subsequent years, and it don't take the distribution. That extra profit can increase the basis. That time the loss can come back, and you can take the loss. Again, it's determined at the personal level. It's carried forward in subsequent years. Use it at it's tested at a personal level. So that's important. And in case of S corporation shareholder, you have to take a reasonable salary. In case of LLC partnership, LLCs, you don't have to take reasonable salary. But if you are a manager for EDD requirement in California, you have to take reasonable salary because as I said, the profit from the LLC partnership, LLC or partnership is not subject to California taxes, subject to self-employment taxes, federal level, not California taxes. So California has determined that to get this, to get some benefit, to get California tax, unemployment tax applicable to those partnership LLCs, you need to run payroll. There's no payroll by the managers of the LLC. So when you form the LLC, make sure it's either manager managed or member managed. If it's a member managed, definitely there has to be one person who is nominated. And if it's manager managed, there has to be one person nominated as a manager. But you have to run some payroll. So you can take a guaranteed payment in case of member managed. In case of manager managed, you have to run payroll as a manager of that entity. So that's important criteria in case of distributions. Basis, I already talked about that one. And then loss reductions, like we talked about the basis calculations. Distribution, I already talked about. Same separate stated items are QBI deduction. QBI information in case of LLCs are different information. They provide a lot of other information like K1 often includes QBI, which is depends upon business type, wages, property, income level. In case of S corporation, W2 wages can help meet the wage limitation thresholds in case of QBI. So common areas, there are a lot of errors that happen in preparations because what happens in most cases we have seen when you get a K1 from partnership, you don't even check whether who is the partner in this and what type of partner is it. Is it subject to self-employment taxes, not subject to self-employment taxes? In case of S corporation, we don't check the basis statement. We don't check whether the S corp is taking reasonable salary or not. We don't check all those things, and we also do not check the AA annual adjustment accounts, retained earnings, accumulated earnings. We don't check all those things when it comes to that. Definitely, there are these things one should be taken into account, and these are general differences between LLC K1s and S corp K1s flowing from these two entities.
So Sanjeevji went over a lot of different things that goes into K1. And I think it's important for you to understand, especially those of you guys who do your own taxes, maybe online on TurboTax or something, you see how many angles he covered. So what happens is typically you get a K1, you go maybe, on online software and just put, picking some boxes and you go on and finalize the return. But you may not realize that there's so many other elements associated with it, and you need to double check each one of those. For example, if your basis is wrong, if you're not decreasing your basis, if your distributions are wrong, if maybe you missed out on self-employment tax, in some cases you have to pay it, some cases you don't have to pay it, and so forth. He went over so many different ideas there. So I hope that kind of helps you. I would suggest if you have a case, work with a professional. It will make your life so much easier. If you need our help, just go to sanjeevcpa.com. If you need consultation, you want to talk over things, ask them to set you up an appointment with Sanjeevji. Or if you're ready to file your taxes, just let the staff know that you would like our help in filing the taxes, and we'll take care of it from there. Now, let me remind you guys that next month we are going to be doing a webinar on FBAR, and kind of like what you saw, what Sanjeevji talked about, all kind of mistakes people make on K1. Similarly, he's going to discuss all kind of mistakes people make when it comes down to foreign income reporting. And there's a lot going on, especially last year, because we had such a great year, especially in gold, silver, all that kind of stuff. So I think it's going to be an important webinar for you guys to join. I think you will learn a lot. So just go to sanjeevcpa.com and sign up for that webinar. Sanjeevji, thank you so much for explaining all this K1. This is great.
Thank you. Thank you.